Welcome everyone to a new PE Forum Fireside Chat. Today we're joined by Jeff Collins, Managing Partner and Co-founder of Cloverlay, an independent asset manager known for pioneering what it calls adjacent private markets, a space dedicated to uncovering niche, diversifying private assets that often sit outside conventional private equity program. Jeff has over 2 decades of experience in private markets, having previously served as a managing director at Morgan Stanley Alternative Investment Partners before founding Cloverlay. We're going to explore today how Cloverlay defines and navigates these adjacent markets, how the firm's investment approach has evolved through changing market cycles, and where Jeff sees the next generation of private market opportunities emerging. Jeff, thank you for joining us. It's a pleasure to have you with us at the PE Forum.
Thank you very much for having me. It's a pleasure to see you.
So, Jeff, I wanted to know, because we can say you're doing something completely different. Was there a specific moment in your career that pushed you to launch Cloverlay in 2015 and to focus on what you call adjacent private markets?
There was a moment, and the moment built up over time inside Morgan Stanley Investment Management in the global private equity practice, where we invested in all strategies, all geographies. One of our primary objectives was to avoid competition. Competition is the enemy of returns, and that can be very difficult to do, certainly at the largest sizes of buyout funds. It can be very, very difficult to do in venture capital. Those spaces tend to get very, very crowded. And starting 25 years ago, we started investing in niche, lower end of the market assets, not operating businesses, but assets that other investors weren't paying attention to. So the mantra was to go where the money isn't and see if there's something interesting to do there. And so after 10 plus years at Morgan Stanley, I sort of turned around and said, wait a second, we've invested $4 billion into these niche, uncorrelated private assets that family offices and institutional investors don't own. Maybe I should set up a dedicated firm to do only that thing and to provide access into this collection of assets that most institutional investors have never heard of or are not resourced to execute on themselves, or are physically located in a place where these assets never come to the region. They've never been seen before. They've never been invested in. So that was the reason for setting up Cloverlay a little bit over 10 years ago.
So there's something that you emphasize in your investments, which is you say they're safeguarded by tangible and intangible assets. And you say that you, as you mentioned, you seek uncorrelated, asymmetric, durable returns across market cycles. So given today's macro environment, could you please define this phrase a little bit more precisely to, let's say, to the Gulf region that might be unfamiliar with it?
Yes. So again, we don't buy operating businesses. We buy tangible or intangible assets. So some examples just to bring it to life, because there's a lot of explaining required when you invest in assets that most investors have not heard of. Every investor on planet Earth has exposure to aviation. It's become an asset class unto itself. For reasons very, very specific to one small part of aviation, no investors have exposure to firefighting helicopters and planes. There aren't very many of them. It's not a $5 billion opportunity. It's a very, very interesting $200 million opportunity. And we've executed on that in two different situations. One, fixed wing airplanes, one, the largest helicopters in the world. That's an example on the tangible asset side. On the intangible side, we have been very, very involved in intellectual property, and we split intellectual property into two different camps. One is content. So we own the intellectual property of a children's brand called the Care Bears. We don't make backpacks. We don't make T-shirts. We don't make movies. Everyone who makes the backpacks and T-shirts and movies pays us a royalty forever and ever. We own the intellectual property they execute. Another part of intellectual property we call mechanical, and it's really technology, patents, and intellectual property. All of the working pieces inside of your widescreen television that enable the television to receive data and show you a picture, those are not owned by the television manufacturer. You can own the intellectual property that's strategically located and collect this long-term, global, durable stream of uncorrelated royalties, independent of how many televisions are sold. So we think about assets themselves, we think about the lower end of the market, and we think about investing in spaces that are the critical assets upon which very, very large industries are built, but no one really realizes what those assets are. The way your cell phone works is because of wireless spectrum licenses. We've participated in 4 different wireless spectrum auctions in the United States. We own the real estate in the sky that enables your cell phone to work. And so AT&T and Verizon have to use our spectrum, but they build the carriers. We own the real estate in the sky, the actual intangible asset.
You're giving a much more clearer vision now. And where would you say your strategy fits within a broader private equity portfolio? Is it catering for, let's say, institutional LPs, or more for family offices, for somebody that's new into private equity, or somebody that's trying to diversify?
So we have $2 billion under management, or we are approaching $2 billion under management. I have to say it that way. As we begin to think about our next fundraising exercise. Across the $2 billion of assets under management to date, the vast majority has come from institutional investors, public pension plans in the United States, corporate pension plans, health systems. It's come from very large family offices. And it's come from a collection of friends of ours in the industry, in private equity broadly, the founders of very large private equity firms that many of your listeners may be invested with, where across all 3 of those profiles, our commercial license, our pitch is the same. You are very sophisticated. You can execute on buyouts. You can probably do co-investments. You probably have venture relationships and real asset relationships. You've never seen a firefighting helicopter or wireless spectrum. That is our reason to exist. And so we cater with the same pitch to different profiles, institutions and institutional family offices, and very, very sophisticated private equity executives.
So I saw a Care Bear backpack in Dubai last week, and so I couldn't help. So from one side you have Care Bear, and then you have, firefighting planes in your portfolio. You invest around 10 to 15 million in these opportunities, but it's very vast. So how do you source? How do you evaluate these opportunities in such a fragmented and less trafficked space?
Right, and another point of explanation as we get to know our partners, because most of the private equity world has been domain focused and they're specialists in a particular industry. And as you said, we have a very, very broad collection of industries and underlying asset types. And we tell interesting stories. They're fun. And so it's very easy to fall into first person and make it sound like I know how to fly a helicopter and I'm making, a children's movie. That is not the case. The consistent theme across all of our assets and the reason that we are able to invest across such a broad range of assets is the shared similarities. We are buying an asset, not a business. We are valuing it because it's a niche, uncorrelated asset. We're valuing it in a very interesting, unique way specific to that small pocket. It's not an EBITDA multiple. There are no public comparables. We have to look at the intrinsic value, the unit economics of the asset. And so the collection of investments in any one of our funds, they have nothing to do with each other, and it doesn't matter what the FTSE or credit markets are doing. They will continue to perform inside their very small ecosystem in an uncorrelated way. That's the reason we do it. And so the sourcing from the deal side has come from a number of different places, but there are no placement agents in our world. These transactions are too small to get the attention of investment banks. And so it's our sourcing mechanism really is our 18-person team building network nodes inside each of these small pockets. And I was talking about this at the end of last week. We are looking very closely at one transaction. Forgive me for not going into detail, but frequently we're doing things that no one else has done, and we don't want anyone to know until after we've done it. So we're looking at it, and it's broadly in the aviation space. It's not firefighting. The person that brought that to us was one of the partners that I invested behind in 2004, converting wide-body passenger configuration airplanes into cargo planes, not a leasing platform. He's shown me 10 things since that very, very successful transaction, and we've said no every single time. We are now deep in diligence with that partner, that network node who lives and dies in his space and knows far more than we do. But we look at the space and say, is this the right time to invest in this kind of asset? Who should our partner be? Who do we know that we can bring into this situation who does know how to fly a helicopter and take it apart? Because that's not us. We're responsible for evaluating the markets in which these assets sit and the value and potential of the individual asset.
I want to continue on, what you mentioned, that is the downside protection. And so when you select an investment, do you look at the macro, or is it purely, as you mentioned, an opportunity through the network you built through your experience in the field?
Yeah, I mean, downside protection is probably the second point that we talk about internally in investment screening, in the investment process, which is, and this is very consistent across all of the portfolios for the last 10 years, which is, I am buying a thing. I am using no debt to do so. If I get everything wrong, how bad can this be? And the answer needs to be, you collect 80 cents on the dollar. If that's your starting point, and you have an interesting asset that you've bought very well because of lack of competition and lack of institutional understanding, and you have an operating partner in place to reposition the asset, if your downside is roughly cost and your upside is in excess of 2 times. We are not venture investors. We're not trying to make 5 times money. We're trying to make 2.3 over and over and over again. That is an asymmetric return that some investors believe doesn't exist in the world. We believe it does, but it's in our spaces, and you have to turn over a lot of rocks to find those opportunities, but they do exist. So that's how we think about downside versus upside risk return profile. Is our starting point has to be incredibly solid.
And you said that it's very niche, it's illiquid. So how do you structure the fund in terms of liquidity and reporting to satisfy the institutional LPs that you have? What are I'd say, the main transparency or governance demands that they have for this particular asset class?
Yeah, very, very good question and critically important. And we've invested heavily internally in process controls and reporting. My first trip to the region occurred in 2006 or 2007. I've been back 5 times in the last 16 months. And so very familiar with the expectations of family offices and institutional investors. And the good fortune is that we built Cloverlay to deliver exactly that thing. And so we are very transparent. We give a high level of detail in terms of the qualitative and quantitative aspects of each transaction that finds its way in the portfolio. We also provide portfolio metrics, of course, and our vehicles are structured. This is a strategy for patient capital. These are not quick flips. We actually have to do something with the assets we buy, and that takes a period of years. And so our fund structures are the traditional 10-year life. The vast majority of the cash activity has occurred by the end of year 7, because we invest in years 1, 2, and maybe the beginning of year 3. When we make an investment, it's usually 5 years plus or minus in terms of hold period. And so that gets you to the end of year 7, where there will be some stubs, which we will clean up, but the vast majority of the cash activity has already occurred.
You mentioned competition within private equity firms. There's a crazy number that said that there's more private equity firms today than McDonald's franchises. And you're in a niche and uncorrelated asset. Do you feel that it is becoming crowded, as some institutions search for diversification, or you feel that this is an artisan work that big institution cannot go into?
I will answer your very, very astute question in 2 ways. The first is, it is our blessing and also our curse that the work in our spaces is so difficult. There are no placement agents, there are no iterative, there are no masters of the universe funds in any of these strategies. That means we have to work harder, we have to go find things, but that leads to less competition. The other part of my answer to your question is that private capital moves very swiftly into new opportunities. And so if you look at our Fund 1 portfolio, which is now 11 years old, you will see data center adjacent assets. We haven't invested in a data center in 7 years. That has become, like aviation, has become an asset class unto itself. Your listeners have their choice of 15 dedicated, highly skilled data center investment firms. Our job was to do it 11 years ago, when none of your listeners had exposure to data centers. Then all the capital comes into the space and we move on. And it's a repeated theme, not in all segments, but certainly in a number of segments where the world changes and there are no all-weather strategies that you can just rely on every year for 15 years. That's not the way private markets operate, and you have to be very willing to stop your work, move on, and say that was a very successful effort inside this one particular pocket, but now this is too competitive. Now my investors are seeing this directly. It's mature, like music royalties, perfect example. We love the asset. We've been in and around music royalties for almost 20 years. There are 8 groups with over $1 billion of dry powder. We can't find anything to do in music royalties anymore, even though we love the asset. It ends up, instead of, you know, our target returns of 15% net and 2 times MOIC, music royalties used to fit there. Now they sit inside credit portfolios and they are, you know, a levered 9%. We love the asset, but it's off mandate for us now.
And your positions are mainly equity, or it can be also credit. How does that happen?
We can be very flexible, but we're almost always control equity. We are the galvanizing event to acquire the assets. We are the control party. The operator works for us. We have all of the governance you would imagine, being majority equity control, and we influence all of the decisions. We are not B round or C round growth investors in someone else's platform. We are the control party.
I'm interested in your decision process. When you have so many opportunities across so many sectors, how do you know which one to prioritize and which one to avoid?
We have talked about tangible and intangible assets. We've talked about aviation on the tangible side. There are other parts of transportation. There are lots of other compartments that fall into the tangible asset side. We've talked about intellectual property. We've also been very active in litigation finance, obscure corners of litigation finance. There are other compartments inside of intangible assets. So there's a lot to do, and we have no buckets to fill. And so as we talk to our current investors as well as prospective investors, we tell them based on what we are seeing in the world. We can never buy another aircraft, and that's fine. We can never buy any more intellectual property, that's fine. As the world changes over our investment period, investment number 6 decision is absolutely influenced by investments 1 through 5. What do we already own? What is most complementary? What are our embedded correlations inside the existing portfolio? What is the embedded? Because nothing is truly, only the weather is truly uncorrelated. Everything else has some kind of correlation. But what is the underlying embedded correlation in this new opportunity? Is that complementary to the underlying correlations that we have here? And that we have already in the portfolio. And that's how we build a resilient portfolio that behaves in a completely uncorrelated way, because you have different, very, very small correlations, if that makes sense.
So basically it's art and then science.
Definitely is. Definitely is.
All right. So if we look at the way you invest, you're very hands-on, you take control, and you often mention, asset repositioning to create this upside and durable returns. Could you walk us through an example or sort of a quick case study of how this happens?
Sure. And this example also is representative of one of your earlier questions about downside protection versus upside potential. This may sound scary to some of your listeners, but I'll throw it out anyway. One of the very first deals we did as Cloverlay was a greenfield cacao plantation in Colombia, Latin America. I will just say it had to be cacao and it had to be Colombia. Otherwise, we never would have gotten there. But due to prior relationships for a period of a decade, we had this opportunity surrounded. The repositioning exercise here was very, very simple. Buying cattle land and turning it into productive cacao plantation. That's repositioning. Our operating partner on the ground, of course, lifelong operator in the cacao ecosystem, specifically in Southeast Asia, not West Africa. And those are the two largest markets in the world, to give you an idea of how we think about it. And if you go around the globe latitudinally from West Africa to Southeast Asia, you pass over Colombia. And there are no cacao, or were no cacao plantations in Colombia. It should absolutely have a vibrant cacao ecosystem. And so the repositioning exercise, you buy cattle land, you buy genetic material, you bring in first world farming technology, and you move on when the trees are 4 feet tall. And you sell to any number of cacao buyers or any number of cacao operators that have no presence in what should be a very large cacao ecosystem. And so that's the repositioning exercise, taking something that looks like version A to most people, but you can see a very clear, easy path, not disruptive, just hard work to turn version A into version B, which is something very, very different. And the downside protection element was we bought cattle land using no debt. And so if there were floods and our operating partner was terrible, we were selling cattle land back to the prior owners for 85 cents on the dollar. But if you get it right, a global candy company comes in and says, I would like to buy all of your plantations, please. And that's what ended up happening.
Would you say that you bring more value, you and your team, at a strategic level or at an operational level?
Strategic level for sure. And I'm very, very glad that you asked the question again. It's easy for me to fall into first person and make it sound like I was wearing boots with mud on them and planting trees. Our job is to know the right operator and to be able to assess the situation. And then our strategic guidance, our helping to navigate capital markets, thinking about the growth of the platform. What are we trying to create here? What is the jump off point where, okay, it's time for someone else to own this because we did what we wanted. We hit all the milestones. Now it's someone else's pleasure to take it off of our hands. We don't try to out-expert the experts, and that's probably a pretty smart thing because our experts in these niches are, they don't know what private equity is usually. They only know their little space. They know cacao genetic material. That's my operator, not someone sitting in New York at a buyout fund. You know, it's someone that only knows how to execute on global licensing and royalty programs for intellectual property. That's all they know how to do. They've never heard of KKR. So they do the operating for sure, and we provide influence and advice at the strategic level.
And today, where does this adjacent universe take you? What are you looking at? Where do you see the next phase for the coming 5 years?
The answer to that question seems to change every 3 or 6 months these days. We are seeing a lot of opportunities in intellectual property with a very broad definition of intellectual property. You can go everything from brands like the Care Bears or My Little Pony or any of the big ones. Also on the mechanical side, but there's a new category of intellectual property beyond those two, but sort of overlapping with those two, of intellectual property around processes, specifically in food, where they're independent manufacturers that have innovated and patented a way of manufacturing or treating or moving or storing food that's been on the shelves for decades in a very new way that saves both the end customer and their partners on the very large corporate side, the Cargills of the world, saves everyone money in an somewhat uncertain macro environment where debt is not as cheap as it has been historically. Yet there's a lot of positive sentiment at the company level about what the world looks like 2 or 3 years from now, but they need capital right now. And so instead of accessing debt markets, instead of diluting themselves with an equity raise, they look at their intellectual property portfolio and say, I never thought this had any value. Someone will buy this from me for $50 million and I can continue to use it. That's actually very, very helpful in a time like this. And we're seeing that I mentioned the food example, but we're seeing it in media where the larger owners of content are focusing on their biggest, best titles and ignoring everything else. Well, we can purchase one of those that we really like and know very, very well, and you have an extra $50 million to go and invest in the largest assets, the key assets. On the mechanical side, same is true. A lot of new with AI, and even before AI, there are a lot of technology companies, given the venture environment that I'm sure you and your listeners are familiar with. It's been a tough window in time if you're not pure AI to sell old companies or invest in new companies or raise new money if you are a company. But a lot of those technology companies own intellectual property. And again, they just thought it was the screwdriver that they used to make their product work. They never thought it had value. And so we've been having a lot of conversations with operators who are technologists that live in the space and say, okay, this company owns this family of patents that we think is also relevant in this other space, the internet or the IoT, making everything in your house wireless. You would be surprised at where that original technology came from. It's not the kind of products or the kind of owners that you would think. Buying those families of patents when they are focused on making televisions, but they own this thing, and it's hard to sell televisions, they might want to monetize the intellectual property. So we've been spending a lot of time there.
It's a bit different from everything you hear usually in these type of fireside chat. And in your opinion, what is the most important quality, or if there's a common quality within your team or anyone who is interested in this field of investing?
The most important quality about our team, I will highlight two things. One is limitless intellectual curiosity. Because in our worlds, we are not handed opportunities. We have to figure out if there is an opportunity and dig a lot of dry holes. But we have a floor full of people here that get very excited about looking into, how, looking at 20-year-old video game intellectual property. There's still 4 million people a day that play one very specific game that was invented in 1997. And they're all older than us, probably. They play every day and it makes money. But the owner of that intellectual property has moved on and is trying to do something much, much, much bigger. But that is an interesting asset that you could potentially do something with. So the first point is the intellectual curiosity to chase down ideas and expand the network and try to figure out if there's something actionable. The other is clearly the analytical skills to pull apart the unit economics of each asset. How does this work? It doesn't matter what the rest of the world is doing. It's not, we think this market will grow 15%. This is, where do the dollars come in? How are they used? And when do the dollars come out of this box? And being able to fully understand that and understand what levers are in your control as an owner and what levers are not in your control. And then take a decision to say, we feel like the control element overwhelms the not control element and this asset is uncorrelated. So it's sort of a marriage of curious and smart, I guess, or curious and nerdy people who love working in Excel.
But basically, you and your team, even when you're on vacation, you're still working because any small idea or meeting somebody could be a potential business.
Working, I mean, we work all the time, but one of the, it's sort of a lame thing to say because everyone says, oh, I work all the time. There's no such thing as August vacation anymore. One of the good things about our segments and our strategies is that there is almost no rush ever. And so the lead time from introduction to closing a deal for us is over 1 year. And we've done 60 transactions. So what that means is, first of all, there's no auction. No one else is looking at it. We have the time to do the work. So there are very few midnight phone calls where the world is on fire and we have to leap into action. But the reason we end up working all the time is because you have a pipeline of very long lead opportunities. Your pipeline can be very, very big. And you have to push everything forward, which ends up being a lot of work, even if they're not fire drills.
Would you advise, somebody graduating today or somebody starting in his career in private equity to look into this space? Or do you think that it takes a specific skill set and a mindset to do it?
I think it does take a specific skill set, and it's hard for a recent college graduate to step into our world because none of it makes sense. So the training ground is probably best at a big investment bank or a large private equity firm, and that's most of the people's backgrounds here. But the personality element or the self-awareness element that I think has led the members of our team to us is looking at how efficient the world is. There are just so many incredibly smart, talented people looking at the same deals. And that's a public market statement, in the hedge fund world, and it's a large cap private equity statement. Is my $4 billion deal better than your $4 billion deal? That's a difficult argument to make. I'd rather be the only person at the party and then try to do something interesting with that asset instead of explaining why my data center is better than your data center. And every single data center investor makes 3 times money. Okay, well, how do you differentiate? There are 30 of you. So is that an interesting long-term career, or is that a point in time where there's so much capital coming into a space, not to pick on data centers, but coming into a space that reversion to the mean, but the mean is actually really interesting. What happens when the mean's not interesting? No one's differentiated. There aren't very many people that do the things that we do. So we feel differentiation might be the calling card. And that's what attracts people, saying, I want to be involved in something where I am judged on my investment acumen, not my ability to beat someone else out for the deal.
And could a deal bring you to invest, let's say, in the Middle East, in the Gulf region? Would this be something that you consider?
Absolutely. We have, one of the very good things, and we sort of say it jokingly with hard lessons learned in the late 90s, early 2000s in Asia specifically. Frequently with our assets, we like assets that we can move if things don't work out the way we want to. So that means real estate in certain countries you would never, ever, ever get involved in because you can't move a building, but you can move a helicopter, And so there are a number of assets and asset types that we're interested in that are very, very relevant for the region. We have a lot of the intellectual property is very relevant for the region, and it's obvious to everyone the push on behalf of several GCC countries to really expand in terms of the locally domiciled large companies that are using intellectual property from all over the world and partnering with very large companies. So there is a lot to do, and I would fully expect for us to have a GCC-centric investment at some point, perhaps during Fund 4. We don't have one yet. But the interesting thing, or maybe to our detriment, is that none of your listeners will know because we don't sell to consumers. You'll never see our name, with an IPO. We're buying those little assets that enable your life to exist the way it does. And we're just picking up the crumbs at the bottom and hoping to do so in an interesting way. But the region is dynamic. I was telling a friend when I was there 3 weeks ago, the region feels like Hong Kong, Shanghai in 2003, 4, 5. You can feel the energy, you can feel the interest of everyone that's involved in the financial world, family offices and institutions. And you can see the traffic that's coming to the region. That's probably annoying for those of you that are in the region, but it's dynamic and it is only growing from here. And that's why we've made a commitment to spend a lot of time there.
Well, hopefully we'll see you as well invest in the region. This would be great
Absolutely.
news. To conclude, what would you say a traditional investor that has never been exposed to this asset class can learn from the way you operate and the way you make your decisions?
The foundation of the way Cloverlay invests really is avoiding momentum. And so many strategies in today's private and public, but private world that many of your listeners are probably just overwhelmed by are exactly momentum investments. That's not to say that's not a smart thing to do, because momentum can continue and investors can make lots of money in momentum-driven themes, but there's also money to be made in the anti-momentum, the boring, the small, on a repeatable basis. And it will never outperform your AI funds, but it's a very repeatable return profile that most of our institutional investors and the family offices that have come along with us have decided that return profile has a place in my portfolio. While I do all the really exciting stuff over here, this has a place because I know what the end result will be. And I feel very comfortable with that. So I would say the biggest takeaway might be a portfolio comprised entirely of momentum-driven thesis doesn't always end well. And as everyone in the region is becoming more and more sophisticated and seeing more and more opportunities, there are diversified portfolios to be built. And we feel like we are a primary component of a diversified portfolio.
I could have started this episode by saying, and now for something completely different. But anyway, Jeff, thank you so much for your time. It was a fantastic conversation.
Thank you very much for having me. It was a pleasure talking with you, and wish you all the best. Thank you.